Hi, what I want to do now is to shift our attention to the other side of the balance sheet and liabilities. What I'm going to focus on first is presenting a framework which we can use this to help us consider the accounting regulation that addresses liabilities. And in doing so, we're going to identify what are liabilities, and our attention initially is going to be on provisions. We can focus on provisions quite generally, and we can focus on specific provisions. And when I talk about specific provisions, I'm probably talking about employee benefits. I'm not going to be talking about financial liabilities at this point in time, because whilst they are liabilities, as the name would imply, they're addressed in a different set of accounting standards which are much more complex, which are concerned with financial instruments more generally, and I want to leave that for another time. Once we understand what liabilities are, we need to think about whether they're relevant. We can think about how they're discussed in the conceptual framework, and we can consider the implications that the framework has for specific accounting standards. What we can then do is work out a plan for working out some of the general purpose accounting standards that address liabilities and provisions in particular. So what are liabilities? Well, liabilities are obligations of the firm, and there's a lot of evidence out that they're relevant to financial statement users. They're relevant to financial statement users because we know that liabilities are often part of a leverage calculation which is used in debt contracts, and firms are often particularly sensitive to the leverage that they show in their financial statements. We know that liabilities also indicate future sacrifices, so we know that warranty provisions are recognised as a diminution in firm value, and we know that environmental liabilities can also constitute a potential loss of value to the firm. So liabilities are relevant to financial statement users and identifying outflows of resources which may materially impact the value of the firm. What does the conceptual framework tell us about the liabilities? Well, a liability is a present obligation as a result of past transactions or events, which is going to result in a transfer of economic resources to another party. For a liability to exist, there must be three criteria satisfied. There must be an obligation, it must involve the transfer of economic resources, and it must be the result of past events. So as long as we meet those criteria, then we have to recognise liabilities. The framework is also relevant in terms of measurement because liabilities have to be quantified. And if we go to Chapter 6, it tells us that there are alternative ways of measuring, and it doesn't specify whether we're measuring assets or liabilities. It applies equally, and it considers an historic cost approach or a current value approach. In relation to liabilities, the only really relevant current value approach is fair value, because to be perfectly honest, value in use or replacement cost aren't really relevant. So what do these measurement models mean? Well, probably the best way to demonstrating what these models mean is to have a simple example. And here I have created a series of cash flows in year one, and you can see that the cash flows occur for 10 years and they total $55,000, and we could recognize them at inception at a discount rate of 8%, and that would tell us that we have a net present value of the liability at inception of $41,124. Now, if we restricted the cash flows to being the same, and if we use the same discount rate, that's a bit like an historic cost approach. You maintain the fixed cash flows and you have the fixed discount rate, which is a bit like the price of money. We could see that after 1 year we'd have paid our first year of cash outflows, and if we discounted it at 8%, we'd see that our net present value is down to $34,414. That to me is very much an historic cost approach. And to me it's an historic cost approach because it's maintaining the fixed cash flows and the fixed pricing of those cash flows. This contrasts with much more of a present value approach, and a present value approach or a fair value approach is saying that we revise the cash flows and we revise the discount rate based on the circumstances existing at the end of year two when we're remeasuring. So what you can see in the extra column added is that we revise the cash flows. You can see that they started at $8,500 now, so the cash flows have gone down. The cash flows, instead of being $45,000, are only $39,000. We discount those cash flows at a new price, and that tells us that the revised value of the liability is only $30,920. So what you can see with that simple example is what I'm talking about when I talk about an historic cost or a fair value approach. Fair value is a bit harder to contemplate for liabilities than it is for assets. That's why I started with the assets. But it has the same principle of allowing the cash flows and the discount rate to vary over time, and that's what you can see in this simple table here. In terms of the implications for standard setting, well, once again, you can say that we could have accounting standards which either adopt an historic cost approach, and if it's an historic cost approach, it's going to require us to determine the cash flows that we have to consider. There's going to be no limit on the cash flows that we recognise because, generally speaking, while we're concerned with limiting the value of assets, we're not concerned with limiting the value of liabilities, and then it's going to stipulate how we recognise the expense. If it's not an historic cost type standard, it'll be a fair value standard, nothing new and original here. And the way that standard will work will be to simply say A, determine the fair value of the liability, and B, recognise any change in the fair value of the liability in the income statement. So what you can see here is that just as with assets we had historic cost and fair value type standards, likewise for liabilities we can have historic cost and fair value standards, and they have the same common structures to them. And if you understand that, then it's going to tell you very much what you're looking for when you're reading the accounting standards. So where do we go from here? Well, we're not going to really talk about any historic cost standards at this point in time. We're going to save that for another day. But what we're going to focus on now is we're going to focus on provisions and the fair value accounting standards. We can talk about provisions quite generally, which is addressed in IAS 37, AASB 137, and we can talk about provisions quite specifically in the context of employee benefits, IAS 19, AASB 119. And the good thing about thinking about these two standards concurrently is that what you'll see is that they address the same issue in exactly the same way. So you could say that in many respects, reading employee benefits is just going to be a rereading of provisions generally, albeit with a little bit more detail, and that's going to make it a damn sight easier to understand. Thank you.